Okay, today we're going to do an explanation of open market operations, right? You got your open market operations, right? So with the open market operations, what you have is you have the Reserve Bank of Australia buying government securities, right? Buying government securities, which is essentially running expansionary monetary policy. Expansionary monetary policy. The Reserve Bank of Australia is basically increasing the supply of what we call exchange settlement funds or exchange settlement reserves, or quite frankly, I just use the word money. They're increasing the supply of money into the economy. Okay, and this will end up lowering the cash rate, or if you prefer, you can just write the interest rate, the nominal interest rate. Right? Remember when I used the letter I, lowercase I. Right? So one is the situation where the RBA is buying government securities from commercial banks. Right? They're buying it from commercial banks. Right? What is an example of a commercial bank? ANZ is a commercial bank. National Bank is a commercial bank. Okay, Westpac is a commercial bank. Just the banks that you deal with every day. They'll buy government securities, and there's expansionary monetary policy. It will increase the supply of exchange settlements into the economy, which will reduce the cash rate, and that will boost economic activity because interest rates will be cheaper. Okay, so that's one aspect of it. What is the other aspect of it? Well, the other aspect of it is basically the reverse of what I've just shown you over there. The reverse of that would be where the Reserve Bank of Australia is going to sell government securities to the commercial banks. Okay, this is a contractionary monetary policy. This will reduce the supply of exchange settlement funds or reserves or money in the economy. It will increase the cash rate, or if you prefer, the nominal interest rate. Okay, and this will slow down the economy. So what does that look like graphically? Both these situations, what do they look like graphically? Okay, so let's start with the first situation, where we have our expansionary monetary policy, and the RBA will be buying government securities from the commercial banks and increasing the supply of exchange settlements and lowering the cash rate. What does that look like on a graph? Okay, so I will just draw that up. So let's cover first situation. And over here you have your exchange settlement funds. Over here you have your cash rate or your nominal interest rate. So it doesn't matter what you write really. You can write cash rate. Okay, I just write cash rate. You could also write nominal interest rate. As long as you're consistent, it doesn't really matter which one of the two you write. Okay, so we start with an initial equilibrium. This here is the demand for exchange settlement funds. Right? You have to keep it simple and say what's an exchange settlement fund. Look, just use the word money. This is the demand for money. And this here is your supply of money, S0. Okay, I'm not going to go into why the money supply is vertical, but just accept it for now. I've explained that in the lectures. And in equilibrium, the nominal cash rate or nominal interest rate is I0, and the amount of exchange settlements, ES0. So this is where we're starting from. Okay, so now in the situation where we're going to run expansionary monetary policy, what we're going to see, if I just make that a little bit smaller, what we're going to see essentially, and try and make that, oh boy, let me try, there we go. is in order to lower the interest rate. Remember, what do we want to do with expansionary monetary policy? We want to lower the cash rate, right? We want to lower that interest rate. The RBA will start buying government securities from the commercial banks. When you start buying government securities from the commercial banks, what is going to happen is the RBA has to pay the commercial bank, right? So what do we have here in this situation? The RBA is buying government securities from the commercial banks, so it has to give the commercial banks exchange settlement funds, right? Basically, it has to give them money. It has to put money into their account at the RBA, okay? Because and in return, the commercial banks will be giving the Reserve Bank of Australia the government securities, right? This will increase the supply of money. So there's going to be a shift out here, and we get a new exchange settlement, a new increase in the supply of exchange settlement funds. Again, you want to keep it simple, you call it money. That's fine with me. It's basically the same thing, right? And we end up going to our new equilibrium. Interest rate or the cash rate falls to I1, and there's an increase in the amount of exchange settlements available in the economy to ES1. So this is an example of running expansionary monetary policy. Okay, the lower cash rate, if you remember, we've got aggregate expenditure equals aggregate demand equals C plus I plus G, right? So we're interested in this I over here. When you reduce the interest rate, it makes it cheaper for businesses to borrow money. Businesses will borrow more money, and that will boost aggregate expenditure and improve the economy, right? Expansionary monetary policy. Okay. And now for the opposite scenario, where the RBA will sell government securities to the commercial banks. Okay, so when they're selling the government securities to the commercial banks will give the exchange settlements to the RBA, right? Again, to keep it simple, what do I mean by exchange settlements? They're basically giving money to the RBA, and the RBA will give them government securities, right? Because they have less money available, less exchange settlements available to lend to the public, there will be a fall in the supply of exchange settlements and an increase in the cash rate, and you slow down the economy. Okay, so let's draw that up. So again, we have our ES funds, cash rate, our initial equilibrium, okay, and then there is a decline in the amount being supplied. S1, we end up in our new equilibrium, I1, so interest rates go up, and the amount of money or exchange settlements available in the economy will fall, and this is your contractionary monetary policy. Again, AE equals AD equals C plus I plus G. We are making it more expensive to borrow money. That should reduce business investment and slow down the economy. Okay, so that is what is going on with open market operations.